Well, I appreciate you having me back on to give an update. Now that we've got year end out a few weeks ago, it's a good time to give an update on Hemisphere Energy. I'm Don Simmons, President and CEO, and look forward to updating shareholders to see what we've been up to and see how the year went and see what our plans are here as we move forward through 2024. So for those of you who know the story, you know the strategy. For those of you that are new to the story, we like to keep things pretty simple. We focus on adding value and returning capital to shareholders. We apply an enhanced oil recovery technique, a polymer flood, in order to capture more of the oil that we have in the ground and in our pools. You'll hear more about that through the presentation. The balance sheet is very strong right now, no debt right now, minimal decommissioning liabilities, so we have more cash and more cash flow to return to shareholders. We have great assets, very profitable, low cost assets, and which in turn yield a very high dividend or a very high free funds flow yield. What makes us so unique as a small company and able to do this? It really is the asset base and the way that we're developing it. It provides us with a very low decline rate with our production. So that means that we just have to spend less money keeping production flat and growing the company, growing production as we move the company forward. And again, that leaves more money to return back to shareholders. So looking at some of the key numbers and where we are, if we look at the map first, you can see we're based in Alberta. The assets are down in southeast Alberta, called Atlee Buffalo. That's where all of our production is today. Great place to do business. It's about a 2-hour drive from Calgary. Year-round access, mostly dealing with farmland. So great area of the province. It also has all the infrastructure and the services that we need to not only grow our business, but to continue to operate on an efficient manner. Just north of there's a new area. We're calling it Manito Lake. That asset is just across the border into Saskatchewan. This is a new area for us that we're testing in 2024. We acquired some land last year in 2023, so it's a big year for us. We've drilled 5 wells into it, and we'll be moving forward with a polymer flood there as we go through the summer of 2024. I'll talk a little bit more about that later. Some of the key numbers, we trade in Canada on the Venture Exchange and in the US on the OTCQX. Share price right around just over $1.70 a share. We've got about 100 million shares outstanding, so the math is quite simple. About $170 million market cap. We are sitting in a cash position at the end of the year. It was over $3 million. So again, enterprise value roughly around $170 million value. Insiders own 15% of the company, so we are incentivized to make all of our decisions on a per share basis and growing that value. And current production, we put out a couple weeks ago, through the last month or month and a half, we've been averaging around 3,500 BOEs a day. And we are a heavy oil company. We're 99% heavy oil, 1% natural gas. So when we talk about our production in BOEs, we really are, majority of that is oil. So let's look back at last year. These numbers were put out a few weeks ago into the market. Last year, we averaged just over 3,100 barrels a day. With that, the sales revenue, almost $85 million. So our operating field net back over $50 million last year. And our cash flow, our adjusted funds flow, which is the money left over all the cost to run the company, paying our taxes, paying our royalties, G&A, just under $40 million last year. So another great year for Hemisphere. We spent about $17 million in the field last year, drilling wells, building facilities, buying land and seismic. So that leaves over $22 million in free cash flow last year. So that's what we were able to pay our dividend with. We were able to buy back some stock last year, and we even paid a special dividend in the fourth quarter last year to reward our shareholders and thank them for sticking out the long downturns we've been through over the last number of years. But it's it's a good time for the industry right now. So this is a new slide. Actually, wasn't in the last presentation, and it's something again, not just looking back at last year, but looking back at our track record. So looking back since we purchased the Atlee Buffalo area, it was about 20 barrels a day. We bought back in 2013, 2014, consolidated a little bit more in 2015. So it's an asset that we've grown organically from, like I said, 20 barrels a day to the 3,500 barrels a day we are today. So you can see that year after year, even through some pretty rough low oil price years, we've consistently grown the company on a production basis per share, on a reserve value in all categories per share. And then the last slide in the bottom right really does tell the story how we built the company. We took on a lot of debt, that's the red bars, in order to build our facilities, in order to drill the wells, to get ourselves from 500 to 1,000 barrels a day, growing through that time, paying the debt back off, and in the last 2 years, going from debt to debt free and starting up a dividend model. So it's been a great run, and we look to move the company forward. You'll notice, in on the time, some of the things that we've done since that purchase in 2013, 2014. 2017 was a big year. That is when we secured a fairly sizable loan to help us develop this asset. And then, as I mentioned, in 2022, we really turned the corner of a company from, tapping debt in order to grow the business, in order to being able to grow off of our cash flow. And then of note, last year, as I mentioned a little bit earlier, we had the extra money to be able to start really aggressively looking at new areas, something that we could bring our experience in with drilling and with enhanced oil recovery, polymer floods, water floods. And we identified an area called the Manito Lake. So last year we spent about $1.5 million capturing a land position and some seismic, and that's going to be a focus for 2024. And with some success there, it will be a focus for the number of years to come. All right, well, let's now look forward. So this slide highlights the guidance for 2024. What are our plans for the year? So there's a couple different price sensitivities there. The green column is where oil was, or oil price at $75 when we put guidance out back in January. As we see ourselves now, we're above $80. So I usually, when I talk to this slide right now, I kind of talk to a range of numbers between the $75 and $85 WTI. So production average for the year, we're looking to average 3,400 barrels a day. So that's going to give us funds flow or cash flow of $40 to $50 million this year. So our Capex plan for the year is about $21 million. So that leaves us free cash flow, free funds flow of somewhere between $20 and $30 million, of which our quarterly dividend is 2.5 cents a share per quarter, 10 cents per year. So that's about $10 million with our 100 million shares out. So that still leaves us, though, free cash flow after the dividend of somewhere between $10 and $20 million, depending on the price of oil. So healthy balance sheet gives us the opportunity with that extra cash to be able to look at acquisitions, which we do continuously. We can continue to buy back stock in the market and cancel those shares. And from time to time, the management and board has said if we don't have an acquisition opportunity in the hopper, then we will consider and look at special dividends. So this is a reserve slide. All the reserve slide is really now looking out farther into the future, past this year, looking out for the next 10 years and beyond. So really a reserve report. It's done by a third party. Every publicly traded company in Canada has to have one of these done annually. And all it is a estimate of our future cash flow as a company at a particular price deck that the third party engineers pick. They look at all of our production, they look at our future production, they look at all our costs, they bring it all together and say, hey, here's what the future cash flow and the value of the company looks like as we go forward. So when you look at three different reserve categories, I tend to really focus on the top two. So the proved, developed, producing reserves is really just, it's your blowdown case. So Hemisphere doesn't drill another well. We just continue to produce out the wells that are producing today. And that estimate is we will produce another 8 million barrels of oil and the value of that oil, almost $250 million. So again, remember when one of the first slides, we talked about our valuation in the market today. We're trading around $170 million market cap, and our blowdown value is significantly higher than that at $250 million. So certainly think that we still represent a very a good value in the market today. A lot of times we look at proved value for valuations of oil and gas companies. And for us, so that's now incorporating future drilling, some of the locations that we'll drill over the next number of years, and include that in the future value. And so for us, that adds another 4 million barrels. So we're up to 12 million barrels on approved valuation, and the value of that discounted at 10%, 325 million. So again, for us at 100 million shares, that's over $3 a share. So a significant increase to that $1.70 that we're trading at today. One thing to note, we didn't talk about it in the last slide when I was talking about the guidance and that $40 to $50 million cash flow. A lot of companies and a lot of investors are looking at oil and gas companies and really trading them on a cash flow metric, not necessarily looking at the asset in more detail when you look at the reserve report. So the market today in Canada anyway has been trading anywhere from, call it 2.5 times cash flow to maybe 5 or 6 times cash flow. So you can see with us at 40 to 50 million of cash flow for 2024, trading at around 170 million. So we're trading a little more than 3 to 4 times cash flow. So again, in the past, in decent markets, oil and gas companies like us, we traded in a 5-6 times cash flow multiple, and that generally lined up with your proved value in your valuation. So that's what we're really looking for as an oil and gas companies today is when and what will be the catalyst to start to move the market back to those more historical norms that we've seen. So now this is taking the reserves that we have and really comparing ourselves. How do we compare to all of our other Canadian oil weighted publicly traded companies? So I think there's another 15 or 16 companies here that have their values out that we're able to take a look at. And again, we're all different sizes of companies, different production numbers, different gas weighting, oil weighting. So the only thing you can really do to compare us apples to apples is look at us on a per barrel basis. So that kind of equalizes us all out. And you can see you want to be on the far left side of this graph. And that's where Hemisphere is. That you look in here on a per barrel basis, our reserves have really the highest value out there. And that's great. That really speaks to the type of asset we have, the long life reserves, the low cost to not only drill and develop the asset, but also the low cost to produce it. The operating costs are quite low. Royalties are very reasonable. And so that altogether gives us a very high value barrel. Now, though, let's take a look at the next slide and see how do we now compare on an enterprise value. So when we look at the enterprise value to the PDP reserves and you compare us, we're way over on the right side, which means that we're just not trading in valuation anywhere near where our peers are based on the reserve value. So, it's a lot of information on this graph, but again, it's the same companies we're looking at here. It's just really now, how are you trading on a PDP value, proved, and 2P? The PDP is the black bars, so let's just talk about that. Most of our peers, you can see there's a green dashed line at the 1 times. So that would be your 1 times PDP. So most of our peers are trading at, or in some cases, significantly higher than their PDP value. In our case, we still trade at about 0.7 times our PDP. And we trade as though we have a very high decline rate, where in reality, we don't. We have a very low, ultra low decline rate. So I think, again, this is just a slide that shows that, the opportunity that Hemisphere presents in the market today. So now let's talk about the asset itself. I won't go into crazy details on the geology or anything like that, but this map really shows the 2 pools we've been developing over the last number of years. And you can see here that we've got, a couple more years worth of drilling. and that's it. We really now are entering into what we call like the cash flow harvest mode of these two pools in Atlee Buffalo. Two pools have different name. One's called the F pool. One's called the G pool. One's a little bigger. G pool's a little bit bigger. It has been our focus. It's a bigger producing pool. It's the pool we first started to we transitioned from a water flood into a polymer flood a few years ago. Based on the success of that, we then moved and went into a polymer flood on the second pool, the F pool. But it's these have been just phenomenal reservoirs. And again, a bit of the history here. We didn't discover these reservoirs. These were pools that were discovered in the 70s and the 80s. They used the technology at the time, vertical wells, to go in and drill a bunch of wells. They produced out about 3 to 4% of the oil that was in place. And then, during probably some low oil periods, these pools really just got shut in and forgotten about, buried in some bigger companies. And that was the opportunity that was presented to Hemisphere. So they were producing the one pool about 20 barrels a day when we acquired it. We looked at it and said, okay, there's a significant amount of oil here. What can we do different? What are we doing? And what's some of the experience we've had in our careers to get more of this oil? And certainly it was using 3D seismic to come in, drill horizontal wells. And after getting the horizontal wells, then converting some of those wells to injectors to increase the pressure in the reservoir and start to push some of that oil around. So initially we started with just a water flood. And then in 2020, during COVID, we had a significant amount of time on our hands, given the low price and the volatility in the market. So we did a study on then increasing the viscosity of our water. So turning our water flood into a polymer flood. And I'll talk about that in the next slide a bit more. But really, we wanted to know the economics and how is that going to work, and will we get more oil, and can we afford to really put this project up and going? And we were pretty blown away. Like the economics, in a $40-50 environment were positive and robust. So we moved forward in that year, even at low oil prices, to move that project forward. By the time we got it up and running, oil was back to $60-65. So it's been a great project and really is now extending the life of these pools. So I'll give you an example. I mentioned, under the vertical wells, they took out about 3 or 4% of the oil that was there. With a water flood, we were projected to get somewhere in the order of, I think, 18 to 20% of the oil that's there. Under polymer flood, and you look at some of the analogs that have used a polymer flood, we're now talking about 25, 30. There are analogs that have even got as high as 35% of the oil. So it's a significant increase of recovery for a fraction more of the cost. So there is a cost to the polymer. It has increased our operating cost by $1.50, $2 a barrel. But again, we're fortunate to have such low op costs that it's still below $15 a barrel, even with those added costs. There is some capital cost for the polymer infrastructure, but again, it's that pricing over the last few decades has come down significantly and allowed companies like Hemisphere to be involved in that. So here's a slide on the polymer and trying to simplify what we do. First off, it's not some crazy new technology. I mean, polymer flooding has been happening all over the world in hundreds of pools for decades. What really, I think, as I mentioned, the cost structures come down on it to allow smaller companies to get in and do this to some of the pools. And that's the big game changer over the last number of years. So again, it's pretty simple. It's not a dangerous chemical. It's a polymer that's used. It's a powdered polymer. It gets mixed in with our water system. It's used in water treatment plants all over the world. And all we're doing in this case, though, is using it to increase the viscosity of the water that we inject back down into the reservoir so that it has a more efficient sweep. Instead of the oil or the water streaking through the reservoir, through the oil, leaving some of the oil behind as it makes its way over to our producing wells, it actually pushes more of that oil over in a better bank, more like a bulldozer pushing the oil through the holes in the rock and the sand grains to our producing wells. So again, there's a diagram on the bottom. of a surface. We drill 3 horizontal wells off of a pad. The middle well that has kind of the yellow polymer wall or polymer bank, that's where we inject in, and we inject and push that oil over to producers on either side of it. So what are we looking for in response once we've started up? An increase in our oil production at our offsetting wells. We look for a decrease in our decline rate, which is phenomenal for oil and gas companies. It's the holy grail to have higher free cash flow. And we're looking to get a higher increase in our recovery factor. I've talked about that. I mean, there's no better way to explore for oil than when you know the oil's there and you can get more of it out. It's cheaper, it's easier, the infrastructure's in place. It's just a huge value add. And the last kind of benefit is you typically, while you're doing your polymer flood, you'll get a decrease in water production. So that actually means you get a bit of a decrease in your operating cost for handling that water. So let's look at the effect of the polymer flood and EOR projects on decline rate. And this is the best way we've found to really show this to investors is the difference in graphically. So on the top graph is a typical oil and gas company that declines on average around 20 to 30% a year. That's their production decline. That's typical. Nothing wrong with these companies. They make lots of money. They're great companies. But you can see that you take one of those wedges, those shaded areas, that's a drill program. That's a year. So they drilled a bunch of wells in a specific year. But you look at that same wedge of wells and you look 2 or 3 years out, and you can see that those same wells are producing significantly less oil than they were in the year that they were drilled. That's normal. Again, nothing wrong with that. That's typical. It's called the treadmill that we talk about. So we've got to continue to spend a significant amount of our cash flow in order to keep production flat and grow the company. When we look at the bottom slide, this here is Hemisphere's data. So this is the effect of a polymer flood. And it's hard to see, but there's a big kind of jump in our production there in the one shade. There's a drill program. It's around 2019. It was a fairly sizable program. You can see this is before we had the polymer flood up and going. We drilled a bunch of wells. We added production. You can see that wedge declines off, just like every other company and every other program. But then look at what happens once we implemented the polymer flood into the G pool and then into the F pool. Those wells now currently are producing at or even slightly above where they were 2-3 years ago. So that is the arrest of the decline rate. It doesn't happen forever. Eventually, these wells too will start to decline. But these years that we have of this low decline spit out an enormous amount of cash flow and free cash flow just to keep the company flat and continue to grow the company. So there's a little box sort of in the middle there that gives it, sort of sums it up on a free cash flow or a cash flow basis. So a company with a 5% decline rate will generate as much cash flow in 4 years as it takes a company that has a typical 20 to 30% decline rate. It will take them 9 years. So that just means, again, there's just more money and more free cash flow to either make acquisitions, to accelerate growth through the drill bit, to buy back stock, or to give and pay a dividend. So what we look at is the more assets we can have like this, the better it is, and the more that these sizable companies are looking for assets like this. So presents an opportunity in the future. Again, I'm not going to dwell too much on this graph. This is sort of taking again historical data from Hemisphere. This is our real data. Once we started being able to see this in our production data, we were able to present it in the presentation last year. But it gives you a bit of a historical view. And looking at our drill programs, this is going back. This is just looking at the wells that we drilled between 2014 when we acquired the property up until 2019. And then again, not looking at any of the wells we've drilled now in the last 3 or 4 years. But you can see that those wells from that 5-year period today, because of the polymer flood, are producing higher than they ever have before. So it's a very, again, this is evidence-based, data-based. This is what we want to see. And this is the type of thing that every company is looking for assets that can perform like this. All right. So all that being said, that's great. Atlee's been a phenomenal asset, a massive amount of value add over the years. I think we paid about $3.5 million for it. We have invested, quite a bit of money over the years, but it's got significant value, proved value of over $300 million. We spend a significant amount of our time looking for the next one. How can we capture another one? How can we get our hands on another asset that we can try this on? So we have spent time, majority of my time and some other people's are just out prospecting. So last year, though, we identified an area that ticked a lot of the boxes that we're looking for. It has the right geology, it has the right oil quality, and more importantly, there was an opportunity to acquire some of the land. So this land has no production on it. It has some old pools and wells that produced oil, but we believe that we can come back in, drill horizontals, start a polymer flood, and increase the recovery of those pools like we did in Atlee. So we've scienced it to death. We've done all you can do above ground. So this year in 2024, though, is the year to test it. And the only way to do that is to spend some money. And so we've put a significant amount of our budget this year of the $21 million is going to be testing this new area called Manito Lake. We've drilled 5 wells to date. 3 of them are planned to be producers, 2 of them injectors. They're not on production yet. They are drilled. We're in breakup season right now, so everything's muddy and the farmers' fields, you can't really drive on them and get into them yet. But once that's over, once we get into Q3, we need to build some facilities, and we're going to start producing and injecting into these wells. And then it's going to take some time, probably 6 to 9 months before we start to see those things, those key indicators that we look for in a successful flood, and we can go from there. Is it going to be successful and we've got quite a number of areas to drill, or is it not successful and we've tried something and it just didn't work? But that's the point we're at today. The nice part about having the cash flow that we do from Atlee is we're able to take these opportunities and try them for just some of our cash flow, at the same time continuing to grow Atlee. So a bit looking last year, we spent about $1.5 million last year acquiring land. I think we have around 12 sections of land. So with success here, we have some running room. We are not looking for opportunities to just add 100 barrels a day or 50 barrels a day or 200 barrels a day. We are looking for meaningful opportunities to really be able to grow the company, 1,000, 2,000, 3,000 barrel a day opportunities. So it's what we see this opportunity as right now, and we'll know more over the next second half of the year for sure, into the end of the year how this play might work out. And the one thing about it on the last part of this slide, very little value. I think we've got about 5% of our 2P value is actually in there. So with success here, we would be looking for increases, significant increases in our reserves. Okay, and we've kind of talked about the return and the mindset on the returning a capital to shareholders through the presentation, but we do pay a quarterly dividend. The last one was in February. We typically announce our dividends with quarterly financials, so Q1, Q2, Q3. The Q4 one, because Q4 and the annual comes out so much later, we tend to do that on its own in the February timeframe, January, February. But to date, we've paid out over $20 million in quarterly dividends, or 20 cents a share. And for anybody that's sort of followed our story, it wasn't that many years ago we traded at 20 cents a share, and it's the same asset base. This is fully funded through our free cash flow, and today, given share price, it's about a 6% yield, so not a bad yield. Special dividend, we've done it once. We did it last fall. Again, the mindset around that is if we're starting to build cash, and we don't have something an acquisition in the hopper or something that we're quite excited about, or somewhere where we see a place to spend some significant capital, then we will consider a special dividend as a management and board. And but I do stress that to shareholders, special dividends are special, and they're not something that we have planned or anything like that. It really is depending on the market. How is production? How is the price of oil? Is it above what our expectations were? And really, what kind of activity do we have behind the scenes going on? Next is the normal course issuer bid, or the share buyback. So again, we don't budget for it, but there is excess free cash flow that we're able to put to there. I think, in general, when we're trading at such a discount to our blowdown or our PDP value, I certainly don't feel bad buying stock back in these levels. And to date, I think this year we've bought back over 1.4 million shares. Last year we bought over 3 million shares, 3 to 4 million shares. And since inception, since we started the buyback, we've bought back over 10 million shares. So, it's certainly something. It's not something that's sort of a set daily thing or weekly thing or monthly thing. It's more opportunistic, and we tend to be able to, have more sellers that we're able to buy the stock, because we can't buy it. Someone has to sell it down on the bid to us. We tend to get more activity in the buyback on days where oil prices drop significantly. So you get days, and we seem to have more than we used to. Oil drops $2, $3, $4. Those are the days we tend to be more active, and somebody panics, somebody sells some stock, and we're able to pick it up, and we accumulate through the month, and then they cancel them at the end of the month. So that's it. I mean, it's a pretty simple story. Quite a niche story, really, for the Canadian market when you look at a lot of our peers. So again, highlighting, we really value the return of capital to shareholders with the model that we have. Why can we do that? It really is the high yield of free cash flow. And why do we have that? It's really a function of the asset and the ultra low decline rate that we have. You marry that with an extremely low decommissioning cost, and right now we have no debt. So we're not spending cash cleaning up, historical messes, and we're not paying a bunch of interest right now. So again, that's more cash to go into the company and back to shareholders. And then, the big catalyst this year is really this new opportunity, this new play. Nothing's a guarantee, but it's something that we're excited about. We have spent money on it to date, and we're looking forward to getting it up and going and see what we get. And that's it. That's the story. If a bit of research coverage there that's available, if anybody wants, they can contact our investor relations guy, Scott Koyach at Briscoe Capital. He can get you the latest and greatest research coverage.
Don, could you just quickly tell us who you are, and also tell us a little bit about your track record?
Sure, yeah. So I'm, my training is geology. So I'm a geologist by training, and I worked, I cut my teeth in the oil and gas business, working with a larger company called Alberta Energy Company, which has transformed over the years to become now what is Cenovus, a very large Canadian oil company, and Ovintiv, which was the gas side when they split years ago, which is now more of an American-based company. They do have some assets in Canada. So that's where I started. It was a great place to start a career. Lots of experience. I think in the first few years of my career, drilled over 100 wells. Mostly horizontal wells, mostly heavy oil, had experience with water floods. So all that experience really, has led and brought to Hemisphere and helped us. In fact, I even mapped the Atlee Buffalo pools 22, 23 years ago when I first started my career. And even at that time had identified that these were pools that would be nice to get a hold of and develop. And we tried at AEC to get them. They weren't for sale, and we weren't able to get them. So they were ones that really always stuck in my mind. And if I could ever get a chance to get those pools, really thought there was a lot of value to add there. So, that's back. I mean, kind of lumped a 23 4-year career into a fairly simplified answer, but some other experience I had. I worked in Ecuador for a few years. Again, heavy oil, water floods. So a lot of my experience has been, with these type of assets. And then, to broaden that out, it's not just me. I'm just one part of the team. I've got a very strong team with engineers and other geologists, geophysicists, and very technically driven, very value driven, and probably most important to many investors is we are all very big owners of Hemisphere. So we're very incentivized every day by our own shareholder, and our own shareholdings, to make sure that we make the best decisions go forward for building value. And I think most investors really appreciate that, and know that if they're investing their hard-earned money in, that we are taking care on those decisions, because we've got all of our hard-earned money tied up in building Hemisphere.
Excellent. How many common shares do you personally hold?
Over 3 million.
Could you summarize 2024 so far, both for Hemisphere, but also if you would like to add some comment on the general oil market?
Sure. I mean, Hemisphere operationally has been up and down. We in our last news release, and I think we even mentioned it in other news releases, had a really cold, brutal start to the year in January, where we had a freeze up in the field where we lost a significant amount of our production for, I'd say, a week and a half, almost, or 10 days, maybe 2 weeks. So that's not something you experience that often as a company. So lots of challenges there, but things came back really nicely. And as we mentioned in the last news release, we averaged in the second half of the first quarter record production of around 3,500 barrels a day. So we had some really bad, and then we had some really great operational things going on in the field. Then we weren't drilling in Atlee. We always like to drill in our main asset in the summer. It is long days, warm days. Everybody likes working then. And it's generally cheaper. So we didn't drill anything in Atlee, but we did do a drill program, those 5 wells in Manito Lake. And the reason for that is we just didn't want to wait to the summer. We would have preferred to drill it in the summer, but we really wanted to get this project up and going. And in order to get it up and running, we needed the wells. We need them in the ground, and then we can start, through the summer, build the facilities and get things going. So, we kicked that off. It was a little bit late getting going, but we managed to get those wells all drilled before what we have is breakup here, which I mentioned before. The snow melts, the ground thaws out, and it becomes a pretty muddy mess. So we were fortunate we got that done before that. So now we're in sort of wait and see mode. And the summer is going to be extremely busy for us. We'll have all the activity for the infrastructure going on in Saskatchewan, and then we'll be kicking off a summer drill programming in Atlee in Q3 as well. So that's kind of Hemisphere from an operational side. Hemisphere from the financial side, I mean, we're obviously be somewhat curtailed on cash flow and stuff from the downtime, but overall, Q1 pricing was still quite solid. So again, I'd consider it solid. But as we're going into Q2 here, I guess we're a third of the way almost into Q2. We've seen even stronger pricing, but not just WTI, but we've also seen the Canadian differential come down significantly. Q1, I think it averaged just under $20 US, the discount or differential. We're trading around 13 right now. So that's a $7 US swing to the benefit of heavy oil producers. Most of that is around the new pipeline, or all of it, I think, is around the Trans Mountain pipeline, which next month is going to be up and running. And so that's a huge catalyst for heavy oil producers in Canada, of which Hemisphere is a heavy oil producer. And it's been reflected in all the share prices, the heavy oil share prices. So you can see, we've had a great run since the beginning of the year. I think since people have started to look at it and say, oh, okay, this pipeline is actually going to happen. It's going to happen in Q2. The time frame it looks like it's coming. These heavy oil companies are going to get a huge boost in cash flow. So for us, moving from a $20 differential to a $12 or $13 differential. What does that mean for a company like Hemisphere? I mean, that's going to add somewhere around probably $700,000 of cash flow per month. So it's a huge catalyst for Canadian heavy oil producers, and so that, I think, we've seen a big benefit from that. Let's move a little higher level on the oil and gas side. Certainly, again, can't stress enough how important this new pipeline is to Canada. We've been subsidizing the U.S. driver for a decade or more. So we'll now be able to get more of a fair value for our Canadian barrel. We may still sell it all to the U.S., but we'll be able to get a more fair value for it. And that means more taxes for Canada, more royalties for the provinces, and hopefully all shareholders continue to benefit from this as well. And then we switch over to more WTI pricing. You can see we've strengthened from into the 70s to into the 80s here as we've gone through the year. A lot of that, I mean, there's a lot of things going on in the world right now. I mean, you still have the Russia-Ukraine issues going on and the crisis there. We've had a lot of tension since Q4 in the Middle East and continued, different strikes one way and another. I mean, it's and that's a very oil-rich part of the world. There's a lot of oil that moves around on a daily basis. So it doesn't even feel like there's a huge premium built in today's pricing for that, because anything can happen any minute. But that certainly has buoyed things up. You marry that with, we haven't seen a big crisis in economies. Inflation's been sticky, but you haven't seen a big recession in the U.S. We don't see a big drop in demand worldwide. In fact, we're at or over 103 million barrels of oil demand a day. It's huge, and we haven't invested in the industry a lot over the last decade. So we're right there. Supply and demand's pretty tight. Yes, OPEC's still holding back a few barrels, but we're in an environment where even when things aren't full bore on economies, we're still seeing $80 oil. It wasn't that long ago. That was a $50 scenario. So you are seeing supply demand tighter, and I think that bodes well going in to the next number of years. I don't have a crystal ball, but I sort of view the overall industry, oil and gas. We're kind of like in the second inning of a decent run here, and supportive environment, supportive prices, and that's sort of that's our mindset, and as we make our decisions is we've got some years ahead of us here with some decent pricing. The last thing I'll mention on pricing and the effect for Canadian companies is really our weak dollar compared to the U.S. dollar. I mean, typically in the past we've been tied to more of a petrodollar, and when we saw higher prices, we would see not parity maybe, but a closer Canadian dollar to a U.S. dollar. And right now we're nowhere close. We're getting the benefit as a producer of another 37% or so right now on the exchange rate. So it's a huge benefit to Canadian producers. And all our costs are in Canadian dollars. So it's a real sweet spot right now. In fact, I don't want to see oil prices they don't need to go higher. I don't want to see $100 oil. All that does is bring on more problems. Then you become a target as an industry. You start to stymie economies. So I'm totally happy with a $80 to $90 WTI and a $12, $13 differential. Perfect spot for Canadian producers.
Yeah, you're in a great spot. So, and let's start with the WCS index, which has, as I said, dropped from $20 in Q1 to, according to strip pricing, $13 differential. How does that vary over the year, and also what's the current future for in 2025?
So, I mean, things are changing dramatically with this new pipeline. Historically, if we look at the last 10 years or even the last 5 years, we've been pipeline constrained. We have had more production and supply than we had pipeline capacity to ship our the oil we're not using in Western Canada out to a market. And we've had to rail some, and there's been at times where even that wasn't enough. So what that happens is that's when we'd see that differential blow out. It's a market mechanism, to the advantage of the buyer, to lower production to get back towards something that you can ship out of the country and within capacity. So what that meant is at times we would see the differential go to 20, 30. We even saw it go close to $40 once, where we were, the WTI was $50 and the discount was 40. So you're not making much money in those periods of time. Now they wouldn't last long because everybody would then curtail production, and because you were losing money on some of your barrels, and it would correct itself. But what this new pipeline will bring is an extra 600,000 barrels a day of egress, which will at least allow us a number of years of capacity to move our oil around, especially in those times where, the key times where we'd have issues would be in the fall, Q4, when refinery maintenance, and right around now, you'd have some refinery maintenance as well in the U.S. And they would just, not need as many barrels during that time, and that would cause the differential to widen. So what we're looking for over the next couple of years is just a much more consistent, more stable differential. And so, I've heard lots of numbers. Some people think it's going to go single digits and stay there. I'm more of the mindset where I think the norm might be happy if we were sort of in that $12, $13 range. Historical average has been 15, 16. I think it should be below that with this new pipeline. But I don't know if we'll really see, single digits consistently. But I'd just like to not have the swings from quarter to quarter. And, you asked about the futures. I think I looked this morning. I think we are seeing for the rest of the year in around high $12 handle to around 13.
Excellent. And that should stick into next year as well.
I think we should see this for a few years. I think anytime there's capacity, oil companies like to fill it. But I think this bringing on 600,000 barrels a day, there's no projects that I'm aware of right now in Canada that's going to add 200, 300, 400,000 barrels a day in one big project. There's no big major oil sands projects. There's some debottlenecking. There'll be some efficiencies found here or there, but I think we've got a good few years here with capacity, to ship our oil out, which should mean we have a reasonably consistent differential for a few years.
Let's speak a little bit about your reserves. So you published a new reserve report, 16 million barrels of heavy crude oil in 2P reserves, meaning you have at the current run rate of 3,500 BOE per day, you have a 13-year reserve life index, and above 10 a year for the 1P. Are there any significant differences in the new reserve report compared to the one of last year?
No, not really. It was more just, again, consistency as we've grown production. I think we grew production just over 10% last year. So again, we're moving those barrels from 2P into 1P and from 1P into PDP. And, and that's really, the function of Atlee. Really consistent growth, drilling, development, and now what we recognize as a company is, okay, we got a couple more years of drilling. We've got lots of reserve life and lots of cash flow to come from there. But we're now, that's why we're looking more, and that's why Manito Lake's coming in, is where are we going to continue to grow the company production-wise, reserve-wise beyond Atlee. And, we're fortunate to have this kind of asset that has such deep value and reserves in order to give us the the time in order to find the next right asset. We don't have to rush out and just buy the next thing that comes along because we want to a little bit more production, a little bit more reserves. We're able to really do deep dive on the type of technical asset that we want. And but year over year, last year, not a significant change. Just everything bumped up in the values. It was nice.
Excellent. And 5% of the reserves came from Manito Lake, your location.
In 2P,
area.
yeah.
But then, so you're saying that you're running out of sort of new possibilities or unbooked drilling locations at Atlee Buffalo, but could you still add some color to what potential do you have to actually find new reserves, and how many unbooked drilling locations do you as of now have?
Oh, I don't even know off the top of my head. I mean, probably 30 or something like that. I mean, it's that's in Atlee, in the Atlee area, greater Atlee area. But so like I said, there's a few more years of development there, or a few more years of spending money. But development, there'll still be things that we'll do. It'll be more engineering driven. In our modeling, we'll see an area within the pool that maybe we're not capturing the reserves that we know that are there. So how do we get that? Is it a well, or is it a reentry, or is it trying something different, some other technology? Growing value and growing production isn't always necessarily, in our case, with the type of pools we have, drilling more wells. So that's, I guess, what I'm saying is Atlee's transitioning to that kind of a pool over the next number of years. And again, the whole goal in the oil and gas game, you want to spend the least amount of money to get the most amount of oil out of the ground. And so that's what we don't want to just go drill wells for the sake of drilling wells. We want to make sure that, that we're capturing and spending, like I said, spend the least to get the most. And, and the hope is we can repeat that kind of success in another area.
Excellent. And so before we'll speak more about Manito Lake in a few minutes, but so could you just walk us through will the production vary over the quarters in this year, and also how much of an impact did the cold in January have on actual production?
So when we put that out on the in the last news release, so we are looking to average 3,400 barrels a day. That's what we put in for our guidance. And we exited last year around 3375 or something like that, right? But we knew we wouldn't be bringing on new production until likely later in Q3. So you're a long ways through the year before you're bringing it on. We didn't anticipate having all the freeze up. So that ended up, I don't have the number in front of me, but we were still just over 3,100 barrels a day in Q1. So despite that, and then the downtime, and then having the wells come on and produce quite nice in the second half of Q1, we averaged around 31. Q2, we had a good run there. So, hopefully we're in around that 3,400 barrels a day if we don't have any downtime or anything like that. And then Q3 hopefully sort of starts that, but hopefully we're starting to bring on some of our new wells through that quarter, right? So at some point we'll get the Manito Lake stuff on, and then once we start drilling in Atlee, depending on the pad, some of them are already tied in, so they're pretty quick to bring online. But I would say by the end, usually when we do this summer program, by the end of September or very early October, we've got all the new wells on. So then you don't really see that big, production add till pretty much Q4.
And in a conservative scenario, what would that production add potentially be, ballpark?
Well, I think we're drilling in Atlee. We have 8 wells budgeted, of which two are injectors, 2 or 3. So anyway, I mean, call it 300 barrels a day. We probably budgeted in there, 350, something like that.
Excellent. So in other words, with that, you should be above, should be approaching 37 BOE per day.
By the end of the year, yeah. I mean, into Q4, I'd like to see that for sure. I mean, I think that's what's planned in order to get our 3,400 barrel a day average through the year. That's, we got to make up for Q1 being 3,100.
And then, so you drilled last year, drilled 8 successful wells in Atlee Buffalo. So this program will be very similar already
Yeah,
in
pretty similar
Q3.
to last year. Yeah.
But you also had one exploration well which wasn't successful. Where was that? And if you just could add some color to that.
Yeah, it was down in southern Alberta. Totally different play type. Every year we tend to take just a little small piece of the budget. Maybe it's $500,000, maybe 600,000, and earmark it to something that is what we would say out of our character, but high risk, high reward. And so over the last number of years, we've just tried something that we know has a very low chance of success, 10% chance of success, but the impact could be massive if it worked. Something new idea, new play, and so we gave it a shot last year, and that particular one didn't work. So don't talk much about it, because these are always concepts that doesn't mean just because one well didn't work that the overall concept isn't right, and we may try one again sometime. And typically we don't say anything anymore because, well, one, it's not a meaningful number until we make a discovery. But most of the time now, you don't go out and spend millions of dollars picking up the land on these type of plays. You pick up enough to test it, and then with success, you generally have a year of confidentiality in Alberta. And so we would then use that year to buy your land position quietly, or to try and keep your competitors out of there for as long as you can. So there's not really, honestly, from the way our company is, and the way, the type of shareholders we have, and the type of asset we have, there's not really any upside to promoting a big exploration shot. I'd rather be able to come at some point in the future and say, hey, we tried this, it worked. We now have another area that we're going to be developing, over the next few years. I mean, that's sort of our approach on it.
That's a good approach. But so then, if we break down, you have a $21 million Canadian capital budget for this year. Mm-hmm. Could you break it down in terms of Manito Lake? How much is going there? How much is going to Atlee Buffalo? How much is going to ARO? And also, if any significant portion of that is through infrastructure rather than drilling.
Yeah, I think off the top of my head, I mean, the Manito stuff, I think we were 5 or 6 million for drilling there, and 3.5, something like that for the facility work there. So it's a big chunk of the budget this year. And then in Atlee, 8 wells there, so you're probably close to 10 million there. So I mean, what are we at? We're close to probably 18 million right there between those two main areas. And then we always put in some money for potential land, even though we may not know what we want right now, but we might find something in our prospecting. So we want to have some budgeted for land acquisition, seismic acquisition. And then on top of that, there's usually some capitalized G&A for some of the technical people and stuff. And that's pretty big. ARO is not a big. I think our minimum spend for ARO this year is 200,000 or something. So it's not a big spend item.
Great. And so with this, so at $80 a barrel WTI, and say the $13 per barrel WCS WTI differential, what approximate royalty rate are you paying?
It's still around 20%. I mean, it'd be maybe a little higher as the price comes up. I would say, low 20s, because in Alberta, the royalty rate scales with the price. So the higher the price, you start to ratchet up. The lower the price, you ratchet down. But I would say in this environment, we're probably looking in the low 20s.
So then let's move on to, and just to clarify for some of the viewers, so it's royalties is on the revenue. So then Manito Lake, your new area, which wasn't or you had announced that you had acquired 10 sections as of the last time we spoke, but
Standards. Well,
the
yes.
area, the location, everything was unknown.
Yeah.
So, how much production are you in a conservative scenario expecting to come from Manito Lake this year?
Oh, we didn't earmark much to it. In the budget, I mean, we may have given it, average for the year, maybe 50 to 75 barrels a day, because we weren't exactly sure when we would be bringing on any production. So, it's not going to, even with success there, we don't have a lot of production ad built in, because again, we don't, probably not going to even see production till sometime in hopefully early Q3, but sometime in the third quarter. So yeah, okay. We don't have a lot built in there.
How many sections of land do you currently have at Manito Lake?
I thought we had said around 12. I think we have about 12 sections there now.
And how large is one section? How many potential locations could it be on one section? If you just could add some color.
I mean, a section is a mile by a mile. So, and again, in this type of play, it depends on the geology and the the reservoir on how many locations you can get in a section. But like if the entire section is covered with oil or has oil on it, you're probably looking at 12, no, it'd be more than that actually, probably closer to 15 to 20 wells per section.
Could you walk us through the drilling plan this year for Manito Lake? And also, when are you starting to inject the polymers?
So drilling's done. So we did that in Q1. And so we drilled 5 wells, and 3 of the wells will be producers and 2 of the wells will be injectors. And then now, like the timing on the infrastructure, it's really probably looking like it's going to be early Q3 before we're able to get in after breakup, get all the equipment we need. I mean, we'll start sooner, but up and running will be at some point into Q3. And then, can we produce a little bit before that, or do we have to wait? I mean, those are things we're working on now. So, I'm trying to let people know that, we're not really expecting any information till sometime in Q3. And even then, it's just going to be initial stuff, right? We're not going to know whether the polymer is successful or not for a number of months. It usually takes 6 to 9 months before we start to get enough data to then look at it and say, yeah, we start to see effect or we're not seeing effect, that kind of thing.
But you're putting in the polymer or injecting the polymers right away.
We are. In this case, so the idea behind this is that, we've got all these learnings from Atlee Buffalo over the last 10 years. And, part of the reason it took us so long to get to where we got to in Atlee was mostly just price of oil and cash flow because of our size. So we now are bigger, more cash flow in this environment. And we've learned lots of little things, what to do, what not to do. And so we're trying to apply that and get to an answer a little quicker in Manito. And so that's why it's 5 wells, to really, give this a good test in this pilot test. And instead of, it's cheaper to start with water and then add in polymer, we thought, well, we know from our, success in Atlee and from our modeling work that polymer should give the best recovery. If it's going to work, that's the best way to do this. So let's just go, let's spend the money now and let's find out. If it works, then we've got some big development plans to figure out over the next couple of years. If it doesn't work, then we'll clean up what we did and move on to try something else.
And then, so what was the average well cost?
It's about the same as Atlee. Wells are around $1 million all in.
You have a drill pad where you drill, and then at the wellhead, how do you get your production or your barrels of oil to market?
So in Atlee, what we do is all of our wells are tied into a central facility. So there's pipelines that go from each pad, and they go back to a central facility. And so all what we would call then emulsion. So it's oil and water and can have some gas a little bit with it. There's not much, but a little bit of gas. We separate the gas out and we use it or we sell it. And then we need to separate the oil from the water or the water from the oil. And so that's what facilities do. We've got a few different types of infrastructure that we use in order to get our oil to sales quality. And to get to sales quality, it's got to have very little water in it. And so we get it to sales quality. And then in our case, in Atlee, which will be similar in Manito, is a truck will come in, they'll pick up that sales quality oil, and they'll drive it a half an hour away, 20 minutes away, 40 minutes away to a sales terminal. And that's where we sell our oil, and the rest, it goes wherever it's required. Most of the oil in southern Alberta goes to Montana, to some of the refineries. But that's how we get our oil to market. The water then that we've taken off, we take that water, we run it back through our water injection system. It goes through our polymer system now, where we add the polymer to get the water back to a certain viscosity that we want it to be. Then it goes back out through our pipeline, our water pipelines, out to our injector wells. And it goes down the injector well and into the reservoir. So it's a system that's continually cycling through the reservoir, and then we just take that sales oil and sell it.
And the central facility, that is owned and fully operated by you?
Yes. Yeah, we own and operate all of our facilities.
So in other words, at Manito Lake, what infrastructure is some of that infrastructure in place, or do you have to put all of it,
nothing,
including well pads? Or that is
nothing.
Fixed,
absolutely nothing there. So back, in the 80s and the 90s, there were companies that went in, and again, just like Atlee, they drilled vertical wells. They took out some of the oil, and then they left the rest. So we are going into an area just like when we did in Atlee. There is no infrastructure. There's no production for us. It is coming in and testing, instead of verticals, going to horizontals. Instead of primary production, we're going to skip right to what we call, tertiary, going into a polymer flood. And we need to build some facilities in order to do the polymer injection and to produce our wells to tank and get our oil to sales quality. So again, you don't want to spend too much money. It's all about spending the least amount of money to get the most out. So we'll do it in stages. Like, we'll do enough for what we have for these wells. With success there, then we'll need to scale up those facilities. If we go drill another 5, 10, 20 wells over the next year or two, then we'll have to build and add on to those facilities.
And so then I think the perhaps most important question is, what production rates, declines would you be satisfied to see, once they're under polymer flooding, to know that, okay, this works?
Yeah, I mean, it's got to be economic, right? Or else there's no sense doing it. So what is that? Again, we're using numbers with our best guesses right now. I mean, I would be happy with anything, initially starting over probably 40 barrels a day. Obviously the higher the number, the better. But I think, with the size and scale, that's not a bad start. And then more importantly, though, what is the impact with the polymer flood? Does it keep, wells at 40 barrels a day for the next 10 years? Does it increase those wells with the bank of the polymer from 40 to 50, 60, 70? Or is there no impact of it all? Like, that, it's such a wide range of variables and possibilities. But that I think on the low end, I mean, that's a number. I think we could still and would still have positive economics around.
And when do you expect to sort of have a good feeling that which way it's going to go?
I mean, our modeling, which again is just a model, sort of shows we should have some indication 6 to 9 months after we start it up. So, maybe by the end of the year, we're starting to see some indication. Maybe it's into early 2025.
Okay, end of the year to early 2025. That sounds good. And so then I think you mentioned that 70% of the original oil in place has been recovered. So,
It, yeah. Yeah,
yes.
around 7%. Obviously, every section's a little bit different, but on average, around 7. Yeah.
And your thesis that the recovery factor could be similar to Atlee Buffalo, where it's around 30% ultimately.
I mean, again, that's part of what we'll find out with doing the pilot. But that, I mean, within the analogs, those are the type of things we look for. Yeah, I mean, if we can get this thing to 25-30% recovery, there's a lot of oil and a lot of value add there.
So then, if you could describe the potential of Manito Lake, I mean, could it become another Atlee Buffalo, or is it smaller?
I think, yeah, I mean, with the land position we have, and like I said, I mean, we're not looking for 100 barrel a day opportunities. This thing could be, it's still the point where this thing can be zero, or this thing could be a 3,000 barrel a day property. That's the goalpost right now.
But is there a scenario where okay, the polymer flooding works okay, it's kind of economic, but it's not it's not going to become another Atlee Buffalo. In that case, how would you be thinking in terms of continuing developing and allocating capital to Manito Lake?
It all goes around economics, right? I mean, if it's marginal, then is it a place? Well, one, we'll take another look at it and say, okay, well, is there a better way to do it? Is there just something we're missing? Something worked, but something didn't. What are some of the other operators doing that maybe they're doing a better job than us? Let's try that or not try it. But yeah, I mean, capital's going to go to your best rate of return, and if we have something else in the portfolio that competes better than that asset, then it's not going to see a lot of activity.
But so then finally, in terms of oil quality, permeability, viscosity, also the quality differential, what can you say so far about Manito Lake?
Yeah, I mean, for us, I mean, we spend a lot of time prospecting for things that check the boxes, right? So it has to be a certain type of geology, certain type of porosity, permeability, and it has to be within a certain range of viscosity and oil quality. And so Manitou, it ticks those boxes, and that's why we're spending a bunch of money there. So now let's find out whether all that together still results in a good economic project.
And do you expect the operating expenses, including transportation, so sort of as you grow production, to sort of be similar to Atlee Buffalo, or?
Yeah, it's a bit of a wild card too with the variables. I think it's certainly going to be higher at the beginning when you've got very little production or no production. There's going to be some added op costs there for sure. But the idea would be that we're able to get it back down at least closer to Atlee type numbers. Yeah.
Fantastic. And then so finally on Manito Lake, if it works out, what kind of capex could we, ballpark interval could we expect for next year?
Well, I mean, over the last number of years, we've been fairly consistent spending $15 to $20 million in Atlee, getting it to where it is. So with success in another project, another area, I would see similar type capex requirements in order to really get the wells you need, get the facilities that are required. So yeah, it could be a fairly heavy capex area.
And then so at $80 per barrel WTI and the $13 WCS in differential, your operating netbacks are high. They're around $45 Canadian dollars per barrel. If one would add, G&A and share-based compensation, it would still be well over, over $40 per barrel. How do you expect G&A to evolve over time? Currently, it's around $4 million.
Yeah, I mean G&A, it should say relatively. I mean, I usually look more of it on a per barrel basis. So, if anything, as we grow, we should see more efficiencies there. Although, with Manito, if Manito takes off or a new area, we might need another body or two just to help us, make sure technically and operationally we can handle it. But yeah, I don't see. I mean, I always look at it. We want to sort of be within the same range as our peers, and I think certainly on a revenue per person and a cash flow per person type thing, we punch quite high above our weight.
Excellent. And then, so what effective corporate tax rate do you expect for this year and also for next year?
Yeah, it's a bit complicated because we still have some tax pools and we still create tax pools, but I mean, I think, if you're using a high teens or 20%, you'll be, you might be a little bit high, but you'll be within range, I think.
So could you give us an update on the status of the M&A market among junior oil and gas companies in Canada? And are you seeing any opportunities?
Yeah, there certainly are opportunities. I think we started to see more opportunities late last year, but then we saw the price of oil come back down into the 70s. We saw the differential widen out, so some of the heavy stuff. We saw that gap between the buyer and seller get wider into the end of the year, and certainly in even in Q1. So we haven't really seen a lot of M&A. But I do see more opportunities coming here now that we're back above $80. It does look like there's some more companies and assets starting to explore some sale opportunities. So I think there's certainly none right now, or very little right now. So I think we will see a little more as we get into closer to the summer, into Q2, Q3. But yeah, it's not crazy. But there's always some opportunity, and it seems like there's more to come.
Yeah, so if the WTI price remains above or at $80 a barrel, yeah, your free funds flow are substantially higher, twice or more than twice of your base dividend. So how will your capital allocation priorities for the year look like in that scenario?
I mean, we certainly want to have some opportunity to look at M&A and look at acquiring or looking at assets that way. So that gives us along with some cash or some building cash, we also have a undrawn line of credit that we could tap for making an acquisition. And then from there, I mean, if we're not winning the bids or we're not seeing things that we like, then, again, sort of depends on the market, but where we're trading and price of oil and where our peers are. But it would be a bit of a balance between buying stock back and potentially, I guess, looking at special dividends if we're really building that much cash.
So you're consistently remaining vigilant and looking at the acquisition opportunities. What sizes are you looking at, and also what's the sort of the max size that you think Hemisphere realistically could, if you really wanted to go for it?
Well, I mean, we look, and I spend a significant amount of time looking at anything from no production, like Manito is just a land opportunity, to I've probably looked at things as big as 2,500 barrels a day, 4,000 barrels a day, 6,000 barrels a day. I mean, we're talking about very different type, combinations, mergers, acquisitions. I mean, we're really looking for any opportunity where we're quite comfortable that 1 + 1 = 3, not 2. And it just if you don't look, then you're not going to find anything. And things don't land on your lap. You gotta dig in pretty hard. Especially, I would say the good deals or the good opportunities are quite often not even for sale. And it's doing some prospecting, doing some work, doing some geology, doing some engineering numbers on it afterwards, and then maybe approaching a company that's not doing anything with that asset, and then it just takes some time. I mean, usually that sends up some red flags, and they say, oh, what do these guys see that we don't? But again, everything's for sale for the right price. So it's quite a wide range. We've looked at assets, we look at corporate. It really depends on the week, and it depends on what might be available. And when something's not available, we're out knocking on rocks to see if we can find something that would fit the portfolio.
So then, the ultimate question: where do you envision Hemisphere Energy in 3 years?
Well, I mean, I think there's probably two routes that I would hope to either see us. Either we're a bigger, better, stronger company even than what we are today, or there's been a market where a larger company wants this type of asset base. They want a low decline in order to bring their average decline down. They like the reserve, life. They like the free cash flow that comes with it. They like the fact that we have very little ARO. They like that, the balance sheet's strong, and they decide to offer something that represents the value of what we've grown. So if that doesn't happen, that's fine too. We'll just continue to look to build the company bigger and better.